Alternative ETFs are booming, but are there risks? This is Inside ETFs, and we're talking alts. The ETF market has expanded way beyond stocks and bonds. They now allow retail investors to buy into private equity and private credit markets that used to be the preserve of institutions and the very wealthy. The crypto blockchain allows companies to offer tokens that give investors a stake in firms that are not public, and relaxed regulation has allowed money managers to issue ETFs based on Bitcoin and other single assets, like those tracking the price of gold. Paisley Nardini is head of multi-asset solutions at Simplify Asset Management. Paisley, let's start with gold. That price has more than doubled in 5 years now. How much of the run-up is down to retail investors piling into the ETF opportunity?
Great question. Gold has absolutely been top of mind for retail and institutional buyers over the last few years. And I think you're right. The baton was really handed from institutional investors over to retail in the last couple months. And I think that's what's given gold some of these legs, and it's really gone parabolic. But I do think looking into some of the data and some of the flows, foreign central bank buying continues to invest in gold. And so I think there's this underpinning of this institutional buyer that will just continue.
If you want to buy a commodity like gold, though, isn't it about owning the physical asset? Why do it via an ETF?
So really the democratization of investing through ETFs, I think, is what's brought a lot of retail investors into markets, especially post-COVID. There, of course, was the meme stock run-up. And I think we've started to see some of this maybe moderate a bit, and we're starting to see investors really go into key parts of the market. Gold has been around for centuries. This is an asset class that for a while just kind of felt boring to a lot of investors. And all of a sudden in a year like 2025, where we have fiscal and monetary volatility, we have geopolitical risks, the rationale for holding this safe haven asset in the portfolio becomes even more evident. And once you pile on the fact that it can deliver this strong return, accessing this through ETFs just makes so much sense for retail investors.
As the gold price goes higher and higher, though, is this about FOMO now? Doesn't it risk becoming an overcrowded trade?
Yeah, we actually just saw in the last few days here, the price of gold reached historic levels from what we call an overbought signal. Again, given some of those tailwinds like foreign central bank buying, continued uncertainty in markets from an equity valuation perspective, the volatility that we've seen in the bond market, I suspect that a lot of these will still be tailwinds for gold prices, but you're absolutely right. This parabolic rise in the price of gold over the last few weeks and months, I think will probably give way to a bit of a shakeout. I think it's normal anytime we see these strong upside potential that there's, pockets of volatility where there may even be more buying opportunity for those that feel like they have missed out on the run up.
More broadly, Paisley, what's driving this boom in alternatives? Why are money managers suddenly offering all these new ETFs?
Let's backtrack to 2022, and that's when we really started to see interest rates rise. Inflation was a key concern post-COVID. And what that meant is this correlation or the movement between stocks and bonds historically had been negative. All of a sudden, they were moving together. And so many investors that solely relied on a stock bond portfolio were left disappointed. They needed more ballast. They needed more offset when their equities hit these pockets of volatility. And so that combined with actually in the US an SEC rule change that allowed greater use of derivatives, all of this came together at the right time and the right place that really catapulted the launch of a lot of alternative ETFs. So investors are now looking to this part of the market to kind of replace that ballast or that equity offset that bonds historically provided that in the last few years have not.
You mentioned that SEC rule change. How much is a more permissive regulatory environment in the US allowing fund managers to offer a lot of products to the retail investor that they couldn't before?
There is a bit of a double-edged sword. So the accessibility or the democratization of these institutional caliber strategies and alternative ETFs is a blessing and a curse. And a curse, I say, because there's so much noise out there. There's so much new products coming to market. And so investors really have to sift through that. That's why we always think as a retail investor, working with an intermediary like a financial advisor can help make sense of all of this, because there's a lot of products and strategies that have come to market that do have a lot of inherent risks or more nuances in how they work and when they work. And so the educational component of alternative ETFs is very important.
Let's dig into some of those risks. If we look at single asset funds relying on something like gold, isn't there a risk that some are heavily over-leveraged, so any fall in the price of an underlying asset could have massive implications?
Absolutely. The leveraged ETF space has grown meaningfully, and it, of course, exists within the commodity space as well. There are strategies that give you commodity exposure and might have a more levered approach to that. And so that goes back to the understanding what you own, kind of pulling back the covers and understanding what's going on, how am I getting exposure, what are the risks? And ultimately, there's no free lunch. And so if a strategy is telling you it can significantly outperform on the upside, that probably means there might be more drawdown risk or volatility. So really understanding what you own, and then more importantly too, is the sizing of it in a portfolio. A 2% allocation in a portfolio is probably not going to have catastrophic impact on the total portfolio value, but a 25% allocation can. And so it all comes down to how you size these positions based on the risk that you view within their strategies.
That was Paisley Nardini of Simplify Asset Management. Don't forget, you can watch more videos on Reuters.com.